So what would a lender do if they were buying in today's housing market? That is the presentation for today. And so if you don't know me, my background, I have 7 years in the mortgage industry. I spent time as a lender. I spent time as a underwriter. I'm active in one of those positions right now. So we're going to get into some actual details because, right, the housing market is kind of tumultuous. There's a lot of things going on. Folks are saying, marry the house, date the rate, all this other stuff. Like, I'm going to say exactly what I would do from my perspective as someone that has bought 3 homes before and knows how lending works, knows a little bit about negotiations. I'm not a realtor, but really from a cost saving and negotiating standpoint from being a mortgage lender, which is really where it's at, right? All right, let's get into it. So once again, we do these trainings every 8 p.m. Tuesday Eastern Standard Time. This is part of First Time Homebuyer School right here. Let me get my highlighter, laser pointer right here. You can check us out on Facebook. That link and information will be in the bio for you. You can check out replays on the podcast, all podcast platforms. You can check me out on TikTok or YouTube at these links right there as well. So let's get into the presentation, right? So I think the first thing to really realize and focus on, we're talking about like, hey, what to do in this housing market if you have to purchase a home or if you want to purchase a home, right? It's to step back and give some perspective to interest rates and home prices. So that's what I'm going to do first. If you follow my weekly trainings, you've seen these slides, but I think we need to step back and understand like interest rates, where are they at? Where have they been? What's a good rate to begin with? So I think a lot of folks have been focused on interest rates being in this 3%, high 2% threshold, because that's all you hear is folks talking about, hey, I got a great interest rate at 2%. I got a 1%. They're lying. I got things in the low 3s. And that's when like a lot of gurus started popping up and just started talking about real estate, or finance and all this other stuff. And it was easy to talk about it because all you had to do was say home prices are going to go up. And you were right. And so a lot of folks don't have perspective on what happened prior to 2020, which is really what matters when we're talking about, hey, what's a good or what's a bad interest rate? So we're going to step back and go back historically first and look at rates. We're talking about what's a good rate? Should I wait to buy? Should I wait till rates go down to buy? And also what I want you to check out in this chart right here, it's from Fannie Mae. They've actually projected interest rates out to the end of 2023. Obviously, it's a prediction, but I would say Fannie Mae has done more research on this topic than probably your friend in the break room, or even a lot of these gurus running around talking about they know this or that. And so their perspective that, hey, rates will probably be in the 6s up until 2023. And that kind of aligns with everything the Federal Reserve is saying and trying to do to combat inflation. Like they've artificially rates in order to combat inflation because they artificially lowered rates during this time frame in order to try to save the housing market during COVID, right? So let's jump back and look at rates from a historical perspective, a bigger POV. Okay, this rates the last month. I got that slide in there twice. Okay, cool. So let's step back. Let's look at rates the last 25 years. So if we focus on this 2020 timeframe, this is just kind of a blip on the radar, right? This whole 2-3% rates thing. So when we're talking about what's a good rate, 2 and 3%, I would take that out of your mind. So really, when we're talking about like what's a good rate historically, we're more focused on something like the 4s, low 5s is kind of like a good rate historically, like the last 10 years. And I point that out to say is that when folks are talking about rates are going to come down, they're only coming down so far. So like if rates do somehow get down into like the low 5s, like they're not coming down to the 3s like any time soon. I would venture for the next 5 plus maybe 10 years. Definitely not the low 3s like the pre-COVID numbers, right? And so to further understand that, you can check out my previous lives on how the Fed impacts interest rates. It has to do with them raising the benchmark rate and the cost to borrow money. So check out the previous lives for a full understanding of how the Fed manipulates the interest rates for the housing market, essentially. All right, and so let's just frame our perspective around that. Like we need to be thinking like a good rate is maybe something in the 4s, and that's probably sometime in like 2024. So that's just the new normal for now, is sixes, hopefully fives, and sometime soon. We're talking about these interest rates. All right, so let's hop on to the next chart. And so this is what we're going to talk about home prices now, right? And so ignore this right there, right? And so this is what Fannie Mae is saying will most likely happen with home prices over the next year. And so they're projecting like a 1 to 1.5% decrease in appreciation over the next year. And so right now we're still like up 9% as kind of like a point of view. So once again, I would shape your perspective of where the housing market is going to go, based on that analysis. So you hear all these folks saying, oh, it's 2028 all over again. There's no data that's saying there's going to be 2020 or 2008, all over again, right? So in 2008, home prices declined 19.7%. A lot has got to happen in order to things to go down to 19.7%. And so once again, I would say check out my previous videos on, and I have all this link below on why this ain't 2008 for more details on that. All right, so now what I want to show you is a rate chart. This is a rate chart, a real life rate chart on a $400,000 loan. And so this is important because we're going to talk about the options to potentially like buy down your interest rate throughout this presentation. And so I want to get you a perspective of what it may cost to permanently buy down an interest rate. So let's see what's what. And so right here, let's look at this example, a 4.375. This is actually a chart I pulled down from 2018, I think is when I got this chart from. So you can see to go from like a 4.375 potentially down to a 3.375. So basically one whole percentage point. It's going to cost you about a little bit over $4,000, right? So that's kind of the perspective we want to frame this conversation around. All right. All right, so this is kind of what I would do if I were like in the housing market right now. So one, you want to use the perception of what's going in the market to your advantage and kind of honestly maybe take a little advantage of people's emotions, because technically we're still in a seller's market by definition. A seller's market by definition is a market where housing inventory is less than 6 months, right? And so I think we're like 4 months of housing inventory, which basically that means is that if there was no more homes in the market, like how long would it take for homes to sell out? About 4 months. So 6 months is a neutral market, and then greater than 6 months is a buyer's market. But there's a lot of people that are just kind of freaking out with what's going on with the market right now, and so you can use that perspective to your advantage. So, like I've said in previous videos, November, December, January is the best time of the year. I'm not saying right now, I'm just saying in general is the best time of the year to buy a home. And it's for the exact reasons that you probably don't want to buy a home, right? It's because it's a lot going on. It's the winter time, like folks don't want to move. It's snowy, bad weather. You don't want to take your kids out of school in the middle of the semester. You don't want to deal with the holiday season going on and all that drama going on, and then put a super stressful thing, which is buying a home on the grill or the barbecue or whatever as well too, right? So if someone's selling their home during that time frame, like why, right? There's probably one or a couple reasons. It's probably a couple unfortunate reasons, like, hey, maybe they're going through a divorce and they have to sell the home. Maybe unfortunately they experience like a financial hardship and they have to like sell the home for whatever reason. Or maybe it's a good thing, like, hey, maybe they got a promotion and they are relocating to another area, so they have to sell their home to move because they can't do the two mortgage thing. So use that to your advantage, especially if like the home's been on the market for like a good period of time. Like the home's been on the market maybe like 3-4 months, and like the seller is looking down the barrel of a November, December, January kind of time frame thing. You may be like, hey, this may be the best offer you may get for, maybe the next couple of months, right? So once again, I would probably, I personally maybe would make a cut, and once again, discuss the strategy with your realtor, right? And so I maybe would make multiple offers like under asking price, maybe like 5-10% under asking price, right? Just to say, hey, maybe somebody will bite on my offer. And so obviously offering a low offer helps with the negotiations as well. If they're like, hey, we counter, and maybe you kind of meet where you really wanted to meet as far as the offer. And so, like I said, I would make a bunch of offers on homes at this level, and always keep it in mind that, especially if this is your first home, like, it shouldn't be your dream home. This is something just to build equity, maybe to, turn into a rental property eventually. But you just want to get in this property like 0% down, 3% down, 3.5% down, and just start your real estate journey. Like, this does not need to be your dream home in the first place. You just want to get in this home and then just move on from there, right? And so once again, we're trying to make offers under market value, or under market value too, but really list value as well, for one specific reason, because it comes with negotiating, eventually having the seller essentially pay for your interest rate buy down, which we'll get into in this slide right here. All right, so now we want to understand how interest rates work, right? So remember I showed you that rate chart a few slides back? I'm going to show it to you again, so no need to go back. But like, so when we're offering, like, let's say we're talking about, like in that scenario, a $400,000 house, right? So if it's listed for like $400,000 and you offer 310, and let's say they accept that 310, that $10,000 reduction in sales price is really only going to move your monthly payment by about $60. I mean, I wouldn't loan you $60, so I'm not saying it's not a lot of money, but and so it comes out to like $720 a year, right? And so I always say this: would you rather have $720 a year from now, and in turn $7,200 10 years from now, or maybe get that $10,000 to help buy down your interest rate, or to help, or to help buy down your interest, right? Or use kind of like a part of it. So maybe if they agreed to like come down to 390, right? You maybe can say, hey, how about this? It's the same money out of your pocket, but how about you come down to, I'll actually offer you 395 on the contract, and maybe you pay us $4,000, and you give us a $4,000 seller credit. So actually, it's only $9,000 less than you wanted versus $10,000 less than you wanted. So right, since they've already come down to 10K, you're negotiating from a position of strength at their point, right? And so let's look at what $4,000 could do for you if you forgot, right? So $4,000 could potentially buy down the interest rate 1% for the life of the loan, which is something that may make a lot of sense, especially if you're going to be in the home for the statistical like 5 to 8 years, right? And so in this scenario, you're paying at $4,000 about on the rate, and it's saving you a little bit over $230 a month. So you can kind of do the math on when you'll break even. To figure out when you'll break even, you take 230 times 12, and then you divide that by 4,000. You'll figure out how many years it'll take you to break even. Or you can just take 230 and divide it by 4,320 plus 148, and you'll figure out how many months it'll take you to break even. So you should do the months. That's a little bit better than that. And so once again, you can have the whole thing to buy down the rate even further, or you can use, you can kind of do like a split thing in order to buy down the interest rate. So once again, we're talking about, we want this to have this perspective on interest rates, right? So right now, let's say you're able to lock in a rate of like 6.5%. Buying down the interest rate 8% will get you down to like a 5.5. And so no one can predict the future, and not me. Fannie Mae is saying rates will be in the 6s for at least the next year. And then so, who knows when rates will really get down to the 5% threshold, but that's kind of like an option for you. Or like I said, you can use maybe the whole McCoy to buy down the rate even further. Like maybe, I'm not sure if the math works out exactly this way, but maybe you can use $8,000 to buy the rate down like a whole 2%. And so now you've gone from a 6.5 to like a 4.5%, which will probably be like the market rate potentially like 2 or 3 years from now. Once again, no crystal ball, can't predict the future, right? Or you can, which is something that will cost a little bit less, is something called a 2-1 rate buy down. So I'm going to do another video going into a little bit more detail on what a 2-1 rate buy down is, right? So, and there's different types of buy downs. There's like a 3-2-1, but essentially what it means is that you buy down the interest rate 2% the first year. You buy down the interest rate 1% the next year. And then year three, it goes back to whatever the market rate is. So like in the previous example, let's say you lock in, like the market rate for you is like a 6.5%. So your first year, it would be 4.5%. The second year would be a 5.5%. Then year three, it will go back up to like a 6.5%. And so one thing to think about this when you're looking at like the 2-1 rate buy down. So folks will tell you this, but don't ever assume that you can refinance it. So if you're not comfortable with the interest rate at 6.5% and the payment that goes along with it, you probably rolling dice assuming that you can refinance 2 years from now. Having said that, right, as we go back and look at the previous chart, rates are like artificially high right now. So don't hold me to this. You can't hold me to this, right? I'm just a dude talking on the internet. But I would assume 2 years from now, so that's what, 2024, late 2024. I would assume rates would be sub 5, but who knows? And so, potentially you get the lower rate for the first year, the second year, and then year three, you can potentially like refinance that loan back to the market rate. But once again, the refinance is not guaranteed, and there are fees associated with the refinance. So, but that's something to put a feather to put in your cap, or instead of a quiver, an arrow to put in your quiver, right, for some time down the line. And so that's what I would personally do. I personally would focus on buying down the rate, because my thing is I want to hold property and real estate long term, because you use it as your primary residence. You get in for that 3% down, 3.5% down, 0% down if you're a veteran or USDA, and then you can potentially rent out that property to other folks. That's why I like to focus on the rate thing long term. But the 2-1 buy down is an option for you as well. So that's the tactic I would take if I was looking to buy potentially in the next 2 years. And once again, use the high rates to my advantage, because high rates are less competition for you in the markets. Folks are just kind of paralyzed by the rates due to kind of that rapid increase. So that is what I got. So cool. I'm about to hop back into the channel to see if there's any questions. If you guys got any questions, drop an X so I know that the question is coming, and then I will answer it. So things are on time delay, so you'll kind of see me sitting there like doing nothing for a little bit of time. But if you made it this far, check out the podcast on all podcast platforms. House Rich, the First Time Homebuyer Show. You can catch all these tips on the go. So for like visual presentations like this, I do an actual like a different version of the thing of the performance of the presentation. Check out First Time Homebuyer School to join the conversation on Facebook. So I let the community actually, for the most part, dictate these topics. So let me hop back on to YouTube to see if there's any questions that folks have. How do I find this? Where am I? Okay, live videos. Okay, cool. If you guys got any questions on what in the world? This, okay, sorry, it's live right now. So if you guys got any questions on okay, if you guys got any question on Instagram or Facebook, YouTube, so I'm all over the place, please let me know. If not, I will log out of the presentation. So still live. Okay, cool. So I will do this economy has to be booming in the US. It's doing all right. I wouldn't say it's booming. It depends who you ask. It may be going down a little bit. So cool. I will start the 10-second countdown if there are no questions. So 10. Okay, cool. We got a question on Instagram. How easy do you think it is to get an investment property that can cash flow considering the current interest rates? I mean, I would say it's no. So one, I would say as far as like your competition. So once again, with the higher rates, I would say use the lesser competition to your advantage. But I don't really think there's any difference now than there was before as far as getting a property to cash flow, because like rates are going up, but it's kind of like it's an old supply and demand thing, right? So with less folks buying real estate as primary residence, there'll be more folks that are renting. So I don't think there'll be like I don't think there'll be a huge difference as far as as far as like the investment property market from my perspective. But I've actually never bought an investment property. To let you guys know, I've actually just always bought primary residence and turned them into investment properties. It's kind of my move there. Why isn't this thing is frozen? Why isn't a refinance guaranteed? Because there has to be a benefit to the borrower in order to refinance, right? So if interest rates haven't gone down, like no one can predict the future when it comes to interest rates, there's no benefit to you refinancing. There's no way for you to know what your financial predicament will be in 2 or so years from now. And so the big thing is you don't know what rates are going to be. You don't know where your personal financial position will be as well. So that's why there's no guarantee when it comes to being able to refinance in the future. All right, cool. Good questions. All right, I'll start the 10-second countdown again. If you guys got a question, drop an X so I know that's coming. If not, I'll start the 10-second countdown before I log presentation. So 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Cool. Okay, cool. Appreciate you all joining me. Okay, we got one question in on IG at the buzzer. I bought a property for $600K fixed in today's market. It's worth 1.7 million. I did a HELOC bank max it out to which I took and just bought another property last week for a still bank fixed. You bought a $600,000 property that was worth $1.7 million. I guess was your housing market. So that's an amazing deal. But yeah, so a home equity line of credit is something you can use to take equity out of your property in order to potentially buy real estate as well. I wouldn't bank on having that much equity in your property when you buy it, though. That seems like some sort of like code. This that's I don't know what that seller was doing, to be honest with you. All right, I'm going to start the 10-second countdown again. So once again, if you got questions, drop an X. I know that's coming. If not, I will tap out in a bit. So 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right, no questions. So I'm going to wait 10 seconds because there's like a time delay. And then I will keep. So, okay. Yeah, if it's freezing, join on YouTube like the thing says. That's literally why I'm on YouTube, because my IG freezes. So you just got to deal with it if you want to watch on Instagram. All right. Okay, we got a question coming. So I'll see what that is. All right, it's long questions, a lot of typing going on. Okay, so I guess I'll just talk about this person types their question. And so, like I said, every Tuesday I cover a different topic. So, like I said, I would say join first time homebuyer school. It literally says click the link in the bio. I'm not sure like how many details like I can give you. Like I don't know what to tell you. And so yeah, so I would say join first time homebuyer school, and so you can kind of join the conversation and to join the discussion. But it's House Rich, the first time homebuyer show. Literally click link in my bio, and it'll take you right to my YouTube channel, and then you can kind of join the conversation then. All right, so Jazer892, you got about 10 seconds to take this question. Unless I don't know why it's so long. I feel like it's been like 30 seconds. All right. Okay, so we do got another question on YouTube as well. And so yeah, so I would say the biggest thing, I'll just filler bust all these people, is once again, nobody can predict what's happening with the housing market. Like I said, these are just my thoughts based on what's happening with the data that I see, right? And so like I said, it's my thoughts because hey, if I tell you interest rates are going to be 3% next year in the art, like what are you going to do? Just on YouTube. So Okay, cool. So I've not seen any questions actually come. So if you guys got questions, actually type them. If not, I'll do the 10-second countdown for when it comes to questions. So let's see. Okay, here we go. The question. Here goes the question. All right. So is investing in real estate lawyer overkill and necessary? I guess it depends what state you're in. I think depending on what state you're in, you have to have like a real estate lawyer. Um, but if you don't have to, like I don't. To me, it's overkill. Just from the perspective from any major lender, every loan estimate closing disclosure is going to be the exact same format from any lender. So it's not like a lender is going to be able to like sneak in some stuff when it comes to like your mortgage. And as far as the real estate contract, so once again, I just know this for state, but so realtors aren't lawyers, and so every contract that a realtor has you sign is typically the same default contract. Like a realtor cannot like just draw up a contract. They can only technically fill in the blanks because they're not a lawyer. So pretty much every real estate contract is going to be, for the most part, the same as far as what you're signing from a realtor. Having said that, I'm not a lawyer either, so I'm not telling you don't get a lawyer, but have the realtor, if there's nothing that the realtor can explain to you in the contract, maybe you may want to get a lawyer in that scenario right there, because per like the real estate guidelines, everything in the contract should be like in plain, understandable English. So if they're using like legal jargon and all that, tell them to explain what it is, and tell them to explain what it is in writing. Like have them make an addendum to the contract saying that, hey, this legal mumbo jumbo means actually this in plain language, because they may be trying to get one over on you. And so yeah, if you don't understand anything in the contract, ask the realtor, and then ask the realtor to explain what that is to you in plain English, right? All right. What credit score would you say is good for a first-time home buyer? So I don't really get into what's a good or a bad credit score. The minimum credit guideline, the minimum credit score to qualify is for NACA technically none, but probably 620. USDA VA technically none, but probably 620. FHA 500 if you want to put down 10%, 580 if you want to put down 3.5%. But most likely you're going to be like most likely a lender wants to get about a 620. Any conventional loan, about a 620 is the minimum there. And so that to me, that's when I say start your real estate journey, is don't focus on like the actual interest rate, because the external factors impact interest rates more. For a good example is in February, if you had a 740 credit score, your interest rate would have been in February, if you had a 620 credit score, your interest rate may have been something like a 3.250%, something like that. In today's market, if you have a 740, your interest rate could be like a 6.5%. So literally twice what that is. So the external factors actually impact your interest rate more than whatever your credit score is. So yeah, I don't really focus on what is the best rate. Just if you can qualify and if it's your budget, it's good to go. You're welcome. And so I'll start my 10-second countdown one more time. So if you got a question, drop X. I know that's coming. Then actually type the question. Other than that, I'm going to count down 10 seconds and then get out of here. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. So there's like a time delay between Zoom and YouTube. So you'll see me say it for like 10 seconds after the fact. But if you got a question on that platform or this platform or that platform, please let me know. Other than that, I will see you guys next week at 8 p.m. Eastern Standard Time. All right, we're out of here.